This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour.
No, I'm not. I'm not thinking about the pause. I'll be writing letters to a lot of countries, and I think you're just starting to understand the process. We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough.
Asian stocks poised to retreat with trade tensions resurfacing. President Trump ruling out an extension of the July 9th deadline while casting doubt on a deal with Japan. Fed Chair Jerome Powell also talking tariffs, saying the Fed would have probably cut rates further this year if not for Trump's trade policy. And the president notching a win as his signature tax bill squeezed through the Senate, but now that legislation faces resistance from some House Republicans.
Take a look at how we're setting up for the Asian market opens. Of course, we have been watching Nikkei futures down 0.2% after the first losses in about 6 sessions. We are also getting the June consumer price numbers for South Korea unchanged month on month, but the estimate was for a slight gain. So we are seeing inflation starting to slow down. Year on year, though, is a surprise to the upside of 2.2%. Of course, these price figures very important for central bankers, including Bank of Korea Governor Lee Chang-yong. But the overall message when it comes to central bankers across the world seems to be one of patience, something that we had heard also from Chair Powell. Take a look at how U.S. futures are also setting up, because we had seen a little bit of a mixed picture in the U.S. markets. We're talking about a rotation out of big mega tech and also going into the Russell 2000. So really outperformance by small caps by the most since April. But right now, a little bit of upside for NASDAQ 100 futures. This as we continue to digest, of course, the commentary coming from Sintra, where central bankers talked about inflation, talked about external vulnerability, and said, of course, the fact that they remain data dependent. Of course, one of the key numbers this week will be the non-farm payrolls coming out on Thursday. We already had job openings coming in at the highest level since November, although on the other side, we had seen manufacturing activity in the United States contracting for a 4th month. Perhaps not surprising given, of course, the tariff uncertainty that we have ongoing right now, something that Chair Powell actually addressed at the ECB forum. Take a listen.
In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
Well, President Trump says he's not considering delaying his July 9th tariff deadline while renewing his threat to cut off talks and impose duty rates on several nations, including Japan.
You're writing letters to a lot of countries, and I think you're just starting to understand the process. We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough, and therefore you'll pay a 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
Let's bring in our digital politics editor, Romy Varghese, with the latest. And so this revival of trade policy hawkishness, are they close to deals with any countries? Obviously, Japan has been sort of dragging on, and it doesn't seem like the sides are getting much closer.
Well, when it comes to deals, we have frameworks with the UK and China. And Trump officials have signaled that they're close with a deal with India. In fact, Scott Bessent, the Treasury Secretary, used the words very close when it comes to a deal between India and the United States. And I should also note that India's chief negotiator has extended his stay in the United States. So that does bode well for a deal with India.
When it comes to a deal with China, we haven't seen that much progress, it seems, according to Secretary Bessent, when it comes to rare earth magnets.
He said that the flow has improved, though not as it was before the the April measures. So we still have to see about that flow. He also didn't say if they were sufficient enough for the agreement or if they were sufficient enough to lift the countermeasures. So I think the signal he was trying to give was that it's positive, but we need to see more. I mean, obviously, these rare earth minerals are key for U.S. businesses. They're key for these transportation and clean energy industries, and they want to see this flow coming back.
I mean, we also heard some commentary when it comes to the sort of Elon Musk situation as well, right? Take a listen.
Tariff of 30. We'll have to take a look. We might have to put Doge on Elon. You know what Doge is? Doge is the monster that might have to go back and eat Elon. Wouldn't that be terrible? He gets a lot of subsidies, Peter. But Elon's very upset that the EV mandate is going to be terminated. And you know what? When you look at it, not everybody wants an electric car.
This battle has sort of gone quiet amidst, of course, Middle East geopolitical issues as well as ongoing trade uncertainties as well. It seems to be revived now.
Yes, it's because the Trump's big tax bill is nearing passage. The Senate passed the bill today, and it's going to the House for its vote tomorrow. And as this bill progressed, then Musk started tweeting furiously about it. But there is a big difference between this and what happened last month. He has been careful so far not to escalate matters. In fact, he said that he's tempted to escalate things, but he's refraining from now. He's not making any personal attacks against the president. I mean, of course, last month you saw him endorse his impeachment and implicate him in sex crimes of Jeffrey Epstein. So we'll see how things progress when the House votes on the bill tomorrow.
Yeah, we'll continue to watch that reality TV show, but it would be huge if really Elon Musk and his citizenship is actually threatened here. That was another interesting aspect to this ongoing feud, it seems. Romy Varghese, really good to have you with us, our digital politics editor, as we want to delve into that tax bill that, of course, has infuriated Elon Musk. Some House Republicans now threatening to defy President Trump and sink the Senate version of a signature tax bill in a vote due Wednesday. The bill only passed the Senate on a tie-breaking vote cast by Vice President J.D. Vance. For more, let's bring in Bloomberg's Alicia Diaz. Alicia, so how much is at stake here when it goes to the House, and how many votes do House Republicans cannot lose at this point?
Speaker Mike Johnson can only afford to lose a very small
We seem to have lost Alicia's audio there, but we'll try and get her back. We've been talking about the Trump tax bill hitting now Republican resistance in the House ahead of that key vote. We'll get more on the tax bill in just a moment. We'll be taking a look at the economic and political impact with the UCLA Law School. Plus, we'll be getting the global rates outlook with Columbia Threadneedle, talking market strategy with Lombard Odier as well. They actually see 3 rate cuts from the Fed for the rest of this year. Much more ahead here in the Asia Trade. This is Bloomberg.
Well, I just heard that about the Senate and the bill just passed, and it tells you there's something for everyone. I mean, it's a great bill. There is something for everyone, and I think it's going to go very nicely in the House. Actually, I think it will be easier in the House than it was in the Senate.
President Trump on the tax bill that's now headed for a vote in the House of Representatives due later on Wednesday. And some House Republicans are threatening to defy President Trump and sink the Senate version of his signature tax bill in a vote due later this week. And if you recall, that bill only passed with the tie-breaking vote cast by Vice President J.D. Vance in the Senate. Let's bring back Bloomberg's Alicia Diaz for some analysis of what to expect next. And, you know, President Trump says there's something for everyone. Certainly seems to be something for everyone to disagree with, because you're seeing both moderate and ultra-conservative lawmakers finding issues with this. Is it sort of dead in the water as it heads to the House?
To be seen. I don't want to overspeak and say it's dead in the water, but it's definitely going to be an uphill battle for House Speaker Mike Johnson. No matter what, there's already at least a handful of Republicans who are saying that they're going to vote against this bill. As you said, it sounds like there's something for everyone to dislike. We have two conflicting groups saying the bill is either too expensive or the cuts to safety net programs like Medicaid are going to hurt their home state. So regardless, it's going to be interesting to see how negotiations play out in the next couple of days. And there will definitely be a lot of external pressure from people like President Trump, who's already taken to social media to kind of put the spotlight on some of the House representatives who are detracting against the bill ahead of a potential vote tomorrow.
What happens if the House blocks this bill?
If the House blocks this bill, it essentially is going to be ping-ponged between the Senate and the House until they can find a negotiation of some of the provisions that are holding up key members to pass this bill. And so, of course, that will lead Congress to extend past this July 4th deadline that the president has really been pushing for. So I think it's going to be up to House Speaker Mike Johnson to really whip the votes as much as he can. And if not, you know, they have the rest of July to continue to talk amongst themselves and figure out some negotiations. But with the X date, it's going to be a hard stop. This bill has to get through the door by that date. So regardless, a lot of pressure will be on House Republicans in upcoming days and weeks.
Bloomberg's Alicia Diaz there with the latest. For more, let's bring in Kimberly Closing. She's the Eric M. Zolt Chair in Tax Law and Policy at the UCLA School of Law. She's also a former Deputy Assistant Secretary for Tax Analysis in the U.S. Treasury Department, serving as the lead economist in the Office of Tax Policy during the Biden administration. Kimberly, really great to have you with us. So we've seen this really just squeeze through the Senate. It looks like it's facing a lot of opposition from really a lot of different GOP sort of counterparties in the House as well this week. What's your assessment of it, and why is this being seen as so problematic by so many different people from different, political viewpoints?
Yes, that's an interesting feature of this bill. It's managed to really generate opposition from across the political spectrum, in part because it has something for everyone to dislike in it. And you can see in the bill the difficulty with generating cuts in spending. They're putting the cuts in spending on some of the most vulnerable in society by reducing Medicaid and reducing food assistance. And that really harms the bottom third of the population about. And so that's generated concern from some of the senators. You heard both Murkowski and Collins talk about that issue. But you also have the problem that the bill generates an enormous amount of new deficits and debt, over $3 trillion, according to the Congressional Budget Office, closer to $4 trillion if you add the additional interest costs, and more like $5.5 trillion if you account for the fact that a lot of the provisions in here are temporary. So that budget picture, starting from a point where we already have very large deficits and debt, makes the U.S. Also look like a very profligate borrower on world markets and risks sort of the interest rate outlook and the macroeconomic stability. So I think that has also raised concerns with fiscal conservatives, including Senator Paul and some in the House. So I think that combination has made this bill particularly difficult. And there's not a lot of great things in the bill for people to really rally behind. So it's been difficult to get it over the line.
It's been interesting because it just sort of adds to the already existing narrative of the end of sort of American markets and economic exceptionalism, right, which hasn't been helped by the trade war. But I do wonder, you've talked about how much this affects sort of lower income earners and some of those demographics. A lot of those people voted for Trump. So do we see the risk of sort of voter blowback if we see the impact on those demographics?
Yes, that's one of the great ironies of this presidency is it was really sold as a presidency that was going to be populist, that was going to help the middle class, that was going to help lower income people. And many of the Trump voters themselves were people without a college education who may be lower in the income distribution. And if you look at the net effect of this tax bill, alongside the higher costs that are caused by the tariffs, the higher energy costs by reducing the energy subsidies, it actually makes 80% of the population is going to have a net income hit from the bill. And really only the top 10% of the population is markedly better off. So the fact that most Americans are being made worse off by the combination of this legislation and the trade wars that you mentioned make this particularly difficult. And that's before we even get into the higher interest rates. When you're borrowing this much, that tends to drive up interest rates. And driving up interest rates will also hit households in their pocketbooks too. One estimate by the Budget Lab at Yale University suggested it could cost the typical mortgage holder an extra $1,000 in interest costs. So this general economic program is really anything but populist, and I suspect it will lead to a lot of voter blowback down the road.
And the way that the Trump administration puts it is that it's supposed to help the broader economy, right? Are there any parts of this plan that can actually support economic growth long term?
I think the business community is going to be happy with some elements of the legislation. I think the element that probably stands out most favorably to tax experts might be the extension of expensing, which is, a small share of the total cost of the legislation, but about $360 billion over 10 years is spent on encouraging investment. That will have some positive effects on investment. But there's a lot of other costs in this bill and a lot of things that are moving in the other direction. So if you're in the business community, you're thinking, well, it's great that I'm getting this tax cut for new investment and research is being treated better. So that's also good. But on the other hand, I have to contend with higher interest rates. I'm having these energy tax subsidies cut off. So my energy expenses are either going to be higher, or if I'm making those investments, I'm going to be worse off. And on top of that, we've got these trade wars going on with nearly every country in the world. And that creates a lot of business uncertainty. It raises costs for businesses since the majority of U.S. imports are actually intermediate goods that businesses need to do their work. So, there's a lot of conflicting signals out there for economic growth. But if you look at the forecasts by the World Bank and by private forecasters, they're all revising down growth rates for the United States over the coming years, in part because of these headwinds caused by the trade war. So even though there's some positive things in this bill, I think it's a really, the big question is whether it's enough to offset these big negative headwinds that are caused by things like the trade war and challenging the central bank independence and other actions.
So if this bill is voted down by the House, are there any clauses within the package that are low-hanging fruits where compromise could be achieved?
I think the ideal compromise here might be to just do a clean extension of the Tax Cuts and Jobs Act provisions that people want to extend, maybe carve out some of the most well-off taxpayers so that they're getting less of the benefit and it's a little more evenly shared. And then not worry about introducing these new budget gimmicks. Part of the problem with this bill is it adds a bunch of new expiring tax cuts. So when you're thinking about this as a bond market participant who wants to loan money to the United States, you're not just seeing the United States borrow a lot more now. You're seeing it's set itself up to borrow even more 4 years from now when a bunch of these temporary cuts expire. So I think if they stick to the basics and just do, a tax bill that would create more certainty and permanence based on the prior Tax Cuts and Jobs Act, I think that would be a more reasonable compromise without, gutting these benefits that people lower in the income distribution really rely on.
How perilous is the risk when it comes to sort of longer-term degradation of the fiscal outlook for the US?
Yes, I think that it is a perilous and a much riskier time than it was 6 months ago. And it's hard to see any one feature being responsible, but it's the combination of things that's really generating these new risks. So you've got a situation where you've got the trade wars going on, and those are highly unpredictable. You hear new announcements kind of almost day by day about what's planned for trading partners and tariffs. At the same time, you've got constant reminders that the president doesn't value central bank independence and really wants the central bank to be doing different things than what they're doing. I think that can make financial markets a little jittery. And then you've got this massive amount of borrowing that's happening. And the borrowing is happening in a context that also shows some degradation of process where senators are adopting new baselines that basically try to pretend that some of the debt isn't there. It's actually kind of difficult to do because we're still getting the real numbers from the Congressional Budget Office, but it does make the United States look like a less reliable a store of value than it was 6 months ago. And I think you see that a little bit in the markets in terms of the depreciation of the dollar. And I think what that dollar depreciation is showing you is that U.S. assets as a whole are perceived as less desirable than they were in, say, January. And I think that's something that the government should try hard to reverse, because that's not an encouraging sign for the U.S. economy.
Yeah, the dollar continuing to lose ground and still at that 2022 low. Kimberly Clausing, good to have you with us. Eric M. Zolt, Chair in Tax Law and Policy at the UCLA School of Law. We have more ahead. This is Bloomberg.
Take a look at what we're watching as we continue to get both uncertainty when it comes to the Trump tax policy and bill front, as well as trade. This is a picture as we see S&P futures a little bit to the upside at the moment, about just less than 0.1% higher there. We're seeing bonds also trading like this, with growing concern over the sort of fiscal implications of this expensive tax bill. The dollar, of course, continuing its run to the downside. We're seeing about 0.1% softer there after the worst first half for the dollar index since 1973. Going into, of course, the Asia trade, Shery, it doesn't look like a great setup when it comes to Japan.
Yeah, because on the other side of the dollar, we do have continuing strength for the Japanese yen. And remember, July is already a historically strong month for the Japanese currency, averaging a 2.8% gain against a greenback usually. And we are seeing the downside pressure on stocks already. We had seen the Nikkei fall for the first time in 6 sessions. And you can see right there, futures are down 0.8%. We do continue to watch the JGB space as well, because we had a strong 10-year auction, but we're looking ahead to 30-year bonds auction later this week as well. We have more ahead on the Asia trade. This is Bloomberg.
Bank of Japan Governor Kazuo Ueda says he's in no rush to raise borrowing costs, signalling a wait-and-see approach on monetary policy. Speaking at the ECB's annual forum in Portugal, he also noted that the BOJ is closely watching how US tariffs could impact inflation.
Headline inflation has been above 2% for almost 3 years, while what we call underlying inflation is still somewhat below 2%. That's the situation we are in. But if I could decompose it further, there's probably about 3 components to it. First, there's underlying inflation dictated by wage price dynamics, whereby increases in prices affect wages, which further affect prices, helped by resilient domestic demand. This component has been going up slowly. But as I said, it's still somewhat below 2%. Then there's going to be perhaps a second component, which will be the expected negative effects of possible tariffs on the economy and on prices. We are expecting this to take place, but we haven't seen that yet. There's a third component, which is a domestic supply shock generated by increases in food prices. Actually, this component accounts for about 50% of the headline inflation we've got at the moment. So netting these 3, we think the first component and the second component will produce a slow increase in underlying inflation toward 2% by end 26 or 27. The third component, food inflation, is going to subside toward the year end. So that we will be closely monitoring interplays between these 3 forces.
But Governor, how do you view trade concerns the day after President Trump threatened Japan with more tariffs?
Well, it's being negotiated by our minister in charge, so I'm trying to avoid making any specific comments on this.
So let me just ask you, what will be the key trigger for Japan for deciding further rate hikes?
Okay, as I said, it will depend on the relative strength of the 3 inflation dynamics I was describing, and we need some more information to determine that.
Bank of Japan Governor Kazuo Ueda speaking to Bloomberg's Francine Lacroix at the ECB annual forum in Portugal, where the message seemed to be one of patience among all central bank chiefs. We're talking about being very data dependent and taking every meeting by meeting. Let's discuss monetary policy around the world and bring in Ed Al-Hussainy, global rate strategist at Columbia Threadneedle. Ed, great to have you with us. Of course, we heard from the BOJ governor, and this is one central bank that's actually normalizing policy by hiking rates. We're seeing a big divergence in monetary paths right now. How much of a risk does that carry in a very uncertain global environment?
Yeah, hi, good morning. A clear divergence between the Bank of Japan and what's going on in Europe and the U.S., where clearly rates are more likely to come down over the course of the next 12 months. And where you're seeing that most prominently is the currency. And one of the risks is that the feedback from that currency starts to actually limit the amount of room that the Bank of Japan has. So in other words, at some point, a stronger yen is going to start to put downward pressure on inflation in Japan. We're not quite there yet. And I think the governor was exactly right in identifying wage pressure as the central story in Japan. So that's something to look forward to next year.
But the key question really keeps going back to the uncertainty from tariffs, right? Whether it's Fed Chair Powell or Governor Ueda trying to see what impact that will have before they actually take their next move. How have you assessed so far monetary policies and central bank chiefs trying to navigate this?
Yeah, it's a really tough spot. I think when you look at it from the perspective of the U.S. and Europe in particular, I think the data set going into the tariff shock is pretty good. Growth in Europe is recovering from the lows of the past several years. Growth in the U.S. remains relatively stable. It's weaker than last year, but it's still relatively stable. Labor markets are still okay. And the starting point for inflation, particularly in the US, is quite good. So to the extent that we're going to see an inflationary shock play through in the summer, perhaps early fall, this is a pretty good data set, and I guess gives both central banks a little bit of time to wait and see how the data plays through. And I think by the time we get to the fourth quarter of this year, we're going to start to transition into action.
How much does the FX scenario, it does look like we're sort of in for sort of the further trajectory of dollar weakening. How much does that kind of give a bit more flexibility to global central banks?
You know, it hasn't mattered that much here in the U.S. yet. We've not seen a lot of pass through from a weaker dollar into inflation here. And I should emphasize that it's early. We will probably see some effect, particularly in manufactured and consumer durables later this year. But where it's going to, I think, play a larger role is in Europe, particularly as a weaker dollar intersects with weaker energy prices. That's going to be largely disinflationary. It's going to start to put downward pressure on inflation later this year in Europe. And it's going to give the ECB a little bit more flexibility and a little bit more room to cut rates and cut rates earlier relative to the Fed.
How do you feel about the tax bill? Is this a game changer in terms of changing the fiscal outlook? Is it more of a generational thing in that it sort of compounds the broader fiscal trends of the past few years?
Yeah, I mean, it's such an important question because fiscal policy is also changing on a global basis. It's becoming more stimulative in Europe, particularly in Germany. It's going to be stimulative here. And I think one of the outstanding questions as we digest this tax bill is to what extent is it going to add to growth in the near term over the next 12 to 18 months? I think this is still a relatively open question. Estimates right now kind of point in the direction of relatively small numbers, somewhere between maybe a quarter, maybe half a percentage point of GDP added to both this year and next year's growth. That's quite modest. If it turns out that these bills are more stimulative, they bring more demand forward, it limits the ability of central banks to cut rates. The Fed in particular is going to have a lot more room to do nothing if there's significant stimulus in the pipeline coming out of this bill.
When it comes to the Treasury market, how much of this bill has already been priced into yields?
Yeah, that's a great question. And I think, you know, the conversation around extending the 2017 tax cuts began as soon as Republicans took control of both chambers of Congress and President Trump was elected last November. Markets have been anticipating this for some time now. And we've had good visibility in terms of some of the additional things they want to do in terms of increasing the fiscal deficit this year and next year. So I think markets, particularly the longer end of the rates curve, has had a really long time to process this information and price it in. And we've seen some of that in the rising term premium, in the steepening of the curve over the course of the past 3 to 4 months. So I think we've done a really decent job of pricing it in. Is it fully priced in? You know, that's rarely the case. But I think a bulk of the impact of this bill is in there. And I'll add one caveat. The next decision here is by the Treasury in its refunding announcement in the fall and this winter. They'll have to decide, how do we fund this deficit? And we're already getting early signals that they don't want to do it with issuing long bonds. That's going to be really critical for the supply picture in the long end of the curve.
We've been looking at the supply picture here in Japan as well, because, Ed, as you said earlier, really fiscal spending is a global story at this point. We're headed towards the upper house elections in Japan. Of course, more spending to come are the promises in the campaign trail. We had a 10-year auction this week, which looked pretty solid. Is that a good indication of the 30-year auction, and could we see that demand?
Yeah, I would say, broadly speaking, across G4 markets this year, I'll include the UK, what's been going on in core Europe, Japan, and the US. Broadly speaking, demand for long-term debt has been pretty good outside of a couple of weeks in April with the volatility there around the tariff announcement. Demand has been pretty good, but we have to acknowledge that in the background, central banks are becoming much less active in terms of treasury markets globally. Central banks like Japan and the UK are running down their balance sheets relatively quickly at this stage. And so on the margin, these markets rely a lot more on domestic demand and a lot less on foreign demand and a lot less on central banks. That's been the pattern, and that pattern is likely to continue well into next year.
Ed, always great to chat with you. Ed Al-Hussainy, who's a global rate strategist at Columbia Threadneedle. Some of the other stories that we're following this hour, and President Trump says Israel has agreed to conditions for a 60-day ceasefire in Gaza. In a post on Truth Social, he says mediators will now deliver the proposal to Hamas, warning them that the deal will not get better, only worse. Trump had earlier said that an agreement on Gaza could come as soon as this next week. Israeli Prime Minister Benjamin Netanyahu is set to visit the White House on Monday. Iran is said to be cutting off communication with key UN nuclear officials. Sources tell us that Iranian regulators have stopped taking calls from the IAEA after formally ending inspections last week. This complicates US and Israeli efforts to prevent Iran from developing a nuclear weapon, with Tehran potentially using strategic ambiguity to dictate events, echoing tactics used during the Cold War. French President Emmanuel Macron and Russian leader Vladimir Putin have agreed to coordinate their approach on Iran in their first phone call since 2022. It is part of efforts to forge a common approach on Iran between the 5 permanent members of the UN Security Council. During the call, Macron also pushed for a Ukraine ceasefire, but Putin rejected that, insisting any deal must address the conflict's root causes. Thailand's Constitutional Court has suspended Prime Minister Paetongtarn Shinawatra while it reviews a petition seeking her permanent removal over alleged ethical misconduct. The political turmoil raises concerns about Thailand's ability to negotiate a reduction in punitive US tariffs. The Deputy Prime Minister will serve as acting leader, with the court giving Paetongtarn 15 days to respond. A Bloomberg investigation has revealed that a hacker stole personal data from Columbia University, affecting 2.5 million student and applicant records. A university official says initial indications show the data was stolen, but the scope is still unclear. It comes with Columbia negotiating to unfreeze $400 million in government funding after the White House accused it of fostering anti-Semitism.
And coming up on the Asia trade, BYD notches its best sales of the year after slashing prices, but the strategies come at a cost to the Chinese EV maker. Details next. This is Bloomberg. BYD registered its best month for car sales this year in June after slashing prices in a move that drew criticism from government authorities and industry groups. Let's bring in our China correspondent Min Lo in Hong Kong. Min, so the sales growth coming at a great cost to the company.
That's right. BYD was slashing prices as much as 34% on certain models to push up its growth in June to 10%. And that brought its first-year sales to 2.1 million units, which is still less than halfway through to its full-year target of 5.5 million units. And you contrast that with its rival Geely, for example, which saw 59% growth on year, much faster growth rates. But of course, granted, it's coming off a lower base there. In absolute numbers, June sales for Geely was just about half of what BYD sold, but the strong growth numbers prompting Geely to raise its full-year target by 11% to 3 million. So we can see that BYD's growth within China is starting to slow compared to some of its competitors, and investors are punishing the company with its stock prices losing about $20 billion in market cap over the past 1.5 months or so because of concerns over those price wars and whether it would eat into profit margins. It's also gotten regulators to take note as well, regulators calling on this industry to self-regulate on prices. And so BYD had, as a result of that, ended some of its discounts. It also had committed to an industry-wide sort of agreement to pay suppliers within 60 days because regulators had been scrutinizing how some of these companies are using supply chain financing as a form of debt.
Overseas sales now even more important for these Chinese brands. Are we seeing progress being made in the European market despite tariffs?
Yes, especially for BYD, which has said that Europe is its most important overseas market. And it's interesting, you look at where we are now, we're actually back to mid-2024 levels before those tariffs had been imposed. And for the first time, Chinese brands' registration in Europe, if you include those ICE vehicles, the internal combustion engine vehicles, it surpassed 5% for the first time. BYD taking the lead there. BYD along with SAIC both surpassed 9% when it comes to the EV category as well as hybrids. And here you can see the chart, the comparison between EVs as well as hybrids. You see a much more dramatic rise in hybrids because those tariffs do not apply to hybrid cars. And so we see some of these Chinese brands really being very nimble. BYD, for example, focusing more on those entry-level vehicles, targeting that segment because of the tariffs. SAIC has pulled back from the pure EVs, focusing more on hybrids again because of the distortion, because of those tariffs. And again, as I said earlier, that price competition at home has really built up the resilience and the experience of these companies, and they're very aggressive as they expand into Europe now, despite those tariff levels.
Yeah, so Beijing really trying to curb that price war among Chinese businesses, right? What are policymakers doing at this point?
Yes, President Xi chaired this high-level economic meeting yesterday, and he urged the country to crack down on this low-price competition and to remove outdated industrial capacity. And this is something that China has actually been working for a long time now. For many years, they have been trying to dismantle these domestic sort of internal barriers between the provinces, because what happens is in China, there are all these provinces that function as individual entities that compete with one another. Whenever the central government comes out with a directive or strategic goal, the local government officials take note and they try to boost their own provinces' production capacity and numbers in order to move up the political chain. And so it created, as a result, a lot of overcapacity. And what the government is trying to do now is to align all the local government practices to remove these protectionist barriers between provinces, to allow freer movement of capital and labor and land and resources across the country. So basically integrate the entire national market into one unified one to create more efficiency. And again, this is getting more urgency now given the broader trade tensions, and it's all the more important for the government now to tackle domestic demand. And that's why this is in focus, because it addresses directly the problem of the deflationary pressure that China is facing now.
Bloomberg's China correspondent Min Lo there. Well, Tesla is expected to report another downbeat quarter, with analysts forecasting a 12% drop in sales from a year ago that would follow a 13% decline in the first quarter. This is despite the company telling investors in April that new, more affordable models remain on track for production. Meanwhile, Tesla shares are off to a rough start this quarter. Elon Musk renewing his feud with President Trump over that $3.3 trillion tax and spending bill. And, of course, President Trump really commenting on that as well, saying that he would take a look at potentially that threat to port Elon Musk there. So the sort of billionaire and president of renewing their fight aside, we know that one of the aspects that Elon Musk has been unhappy with is really the removal of some of these EV incentives within this tax bill. And it really kind of adds to the broader trend of the United States as a market entirely for electrification and for renewable energy sources, losing that race to China. So developing to Asia, including China, right? But developing nations in this part of the world, Vietnam, Bangladesh among them, really growing their share of electricity faster. We've seen this new report also finding that China's doubled electricity's share of primary energy since the year 2000. The US as well as Europe have really stagnated, and that ultimately electrification is crucial for economic growth, Shery.
Yeah, and really with the United States pulling back from that energy transition, we have seen that demand for EVs soften. So you are now seeing businesses also adjusting their strategies in the American market. We're talking about Toyota delaying its production of an electric SUV. We we're seeing strong demand for Toyota's fossil-fueled Grand Highlander SUV. So they actually want to make capacity for this vehicle instead of the planned electric SUV that they wanted to push out this year. In fact, that's been delayed to 2028. And it just really strengthening the point that you made earlier about how the U.S. is really falling behind Asia when it comes to that energy transition, whether it's EV, solar, wind projects, and other cleaner energies. We have more ahead on the Asia trade. This is Bloomberg.
The U.S. economy is in a pretty good position. Inflation has come down close to 2%. We're at 2.3 headline, 2.7 core. The unemployment rate is at 4.2%, so we're healthy overall. If you ignore the tariffs for a second, inflation is behaving pretty much exactly as we have expected and hoped that it would. We haven't seen effects much yet from tariffs, and we didn't expect to by now. We've always said that the timing, amount, and persistence of the inflation would be highly uncertain, and it's certainly improved that. So we're watching. We expect to see over the summer some readings, higher readings, but we're prepared to learn that it can be higher or lower or later or sooner than we'd expected.
But, Chair, would the Fed have cut more by now if it weren't for the tariffs?
So I think that's right. In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
Fed Chair Jerome Powell at the ECB's forum on central banking in Sintra, Portugal, and you heard it there. They're waiting. That message of patience really permeating throughout that panel conversation by central bank chiefs. We have seen the U.S. dollar, of course, under immense pressure, still at around that 2022 low again. And this coming at a time when on the other side of that trade, we had the euro gaining for 9 sessions, their best winning streak since October 2004. We have seen on the other side of that trade also the Japanese yen leading the gains against the greenback. And if you can see on that right side panel, that's your function SEAG GO, which will tell you that July is historically a strong month for the Japanese currency, averaging a 2.8% gain against the dollar. The market opens in Sydney, Seoul, and Tokyo are next. This is the Asia trade. We're counting down to Asia's major market opens. And of course, we're waiting for any updates, Haidi, when it comes to trade deals. President Trump saying that he doesn't want to extend that deadline on the pause on his blanket tariffs at a time that he's been pretty busy also trying to pass his tax cut bill in Congress.
Yeah, whether it sort of runs into more resistance in the House remains to be seen, but it does seem like this is a bill that's attracting criticism and pushback from both moderate to ultra-conservative GOP lawmakers, right? So we'll be watching that very closely, a big political win potentially being set up for Trump, but you do also wonder about some of the voter blowback from this bill too.
And also the market implications for the Treasury space, as we're expecting, of course, more issuance and that debt to rise for the United States. That will have implications for Treasury yields, for the U.S. dollar as well. We have seen the dollar still under pressure at that 2022 low. And on that other side of the trade, you have the Japanese yen strengthening around that 143 level against the U.S. dollar. And remember, July is a historically strong month for the Japanese yen. Average gains of 2.8% so far. Historically, you can see that already weighing On Japanese stocks, the Nikkei down 0.9% after already logging the first loss in about 6 sessions or so. We continue to watch the JGB space as well because we had a solid 10-year auction, but we're also headed towards a 30-year auction as well, and what that will mean for volatility in the JGB space, as of course we have fiscal concerns just globally. We have heard from the Bank of Japan, central bank chiefs getting together in Sintra, Portugal, and really the message being that they're in no rush. It's all about patience. That was a message from the Bank of Korea as well. Take a look at how Korean stocks are coming online, because we had heard from Lee Chang-yong at that panel talking about waiting to see the impact of course, the President Trump's tariffs across the economy. You can see the cost under a little bit of pressure. You can see the Korean won strengthening against the U.S. dollar. Haidi.
Take a look at what we're watching when it comes to that staggered start to trading here in Australia. We're just coming online, so always a bit hard to get a read, but already we're seeing that pop of about 0.4%. This is really a market that is still trading at pretty close to those record highs. We had a mixed session in the previous session, and we saw sort of industrials drop, some of the strength across property gaining as we continue to see that acceleration of home prices here in Australia as well. We're watching some of the copper and mining names as well, given that the price of copper hitting that 3-month high should support some of the metals and mining names here in Australia as well. But take a look at what we're watching for treasuries, of course. So much implication when it comes to what we expect to see with this passage of the tax bill as it now heads to the House. But take a listen to what we heard from Fed Chair Powell, who really spoke about, amongst other things, the implications of the uncertainties on trade and how that's sort of informed the path forward for the Fed.
In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
Our next guest has a base case of 3 Fed rate cuts this year. With us now is Homin, who's a senior macro strategist at Lombard Odier. Fed Chair Powell really just pointing to how much uncertainty and unpredictability the tariff scenario brings to the case for monetary policy making. How confident are you when it comes to that call for 3 rate cuts? Markets at the moment looking at 2, potentially 1 as early as July is sort of in with a chance.
Well, we think it comes down to the forecast for the U.S. labor market. Now, we assume that there will be, due to corporate margin erosion resulting from U.S. tariff, we expect the hiring in the U.S. to slow down a little bit further. So we expect the unemployment rate to tick up a bit and the payroll gains to slow down further over the rest of the year. And if that forecast is correct, then we think the Fed is basically biased to react to that development as opposed to the temporary spike in inflation that's quite likely between now and the mid-2026. So if you assume that somehow we avoid the bad outcomes for the labor market, despite this slight setback in the mix between growth and inflation, then perhaps you could be slightly more conservative about rate cuts that could occur over time. But we think due to this expectation of deterioration in the U.S. labor market, it makes sense for the Fed to consider 3 rate cuts before the end of the year. And entering 2026, we'll certainly have greater political pressures for the Fed to maybe keep the monetary policy on the accommodative side. So we are actually assuming that the Fed rates will come down to 3% at the end of 2026 when this easing process ends under quite likely a different Fed chair appointed by Mr. Trump.
There's definitely that uncertainty, but also when it comes to trade, are you optimistic about the abilities of these parties to come on board for meaningful deals? Because we've heard President Trump sort of resuming a more hawkish tone, right, saying that he's not going to extend that deadline and criticizing the talks with Japan.
Well, the Japanese case is definitely quite a tricky one, and it requires a lot of attention because it potentially sets the template for the other surplus economies in Asia, including South Korea and Taiwan, and some ASEAN economies even. So We assume that it's simply a reflection of the fact that the trade talks have been relatively tough with the Japanese side not budging on the opening of the agricultural market, perhaps, and also this sensitivity on auto tariffs that President Trump is insisting on. So due to these reasons, we'll have to see. But ultimately, if you take a step back and look at the UK template for potential trade deals, we see significant scope for the U.S. trading partners to eventually gravitate toward that kind of a deal. It will remove uncertainties surrounding the Trump tariff deadlines. That's the first point. And also the UK deal pointed to some scope for exemptions and carve-outs specific to a country. For instance, the auto sector tariff that's slightly lower for the UK for first 100,000 cars. And also steel and aluminum tariffs that's actually slightly lower than what Mr. Trump is applying to the other trading partners. So ultimately, we think there's a scope for both sides to come to some sort of agreement before July 9th, either outright agreement or a framework to extend the deadline so that they can work on a deal. And we are getting some constructive signals from some of the Asian economies, such as India. So we simply assume that either before or after the July 9th deadline, will ultimately settle on a deal that's similar to the UK deal for many of these trading partners. And if that's the case, then the markets maybe will be able to look through these noises.
Homin, the issue, though, is that we're just making a lot of assumptions at this point, right? We have no idea how these trade developments could unfold, especially if we follow perhaps some of the trading strategies, the taco trade. President Trump always sort of backing down at the last minute. We could be a little bit more optimistic about what could come out with these trading partners across Asia. But central bankers, this is such a headache. What does this mean for the Bank of Japan if the trade talks are derailed, if still you get this pressure on the Japanese economy, and Governor Ueda is trying to normalize? Where does the Japanese yen go, and subsequently, of course, the stock markets?
Well, I think Governor Ueda already has hinted at his Beijing stance at his panel speech at Sintra, which is to simply wait and see, and see if the data are consistent with the underlying inflation rising further in line with the BOJ target. So what we assume for Bank of Japan is that they're going to wait, and our base case right now is that it's for the Bank of Japan to actually wait until the end of this year and early 2026 to consider additional rate hike. If you look at the macroeconomic data in Japan, actually they have been relatively resilient apart from the industrial sector data that have been somewhat more wobbly. So it makes sense for the central bank to not refrain from introducing new shocks to the industrial sector and wait until the conclusion of the trade talks and potential bilateral deals to consider policy normalization. So it is true that some market participants are still worried about potential fiscal package coming from the diet after the upper house election and relatively high inflation data. But our suspicion is that the Bank of Japan will simply look through this and wait for the moment where the dust settles down on trade and election and also the bond market volatility. So that's all points to the next hike happening in first quarter 2026, not this year. And that kind of patient stance should be okay for Bank of Japan to adopt. Now, for the yen and the equity markets, this is the reason why we don't assume a massive appreciation for the yen, despite the weakening dollar environment. And for the equities, we still think this kind of patient stance should be supportive in the end.
The risk rally seems to be really backed by the fact that economies around the world have been pretty resilient, right? Was that the case also for emerging markets and why we continue to see this extension of the bull run? Or is it more about valuations? And if that's the case, could that still be the case for the latter half of this year?
But despite the rally, a lot of the large emerging markets still remain relatively cheap compared to their developed market peers. And despite the slowdown that's happening in the economy, investors are already looking forward. And the softening dollar environment is definitely a plus for these markets. So certainly, if you think about the broader macroeconomic context, it might not be as bullish as the context that we faced maybe at the start of the emerging market bull rally in 2000s. But the calm on dollar front that allows for easier policy in these markets and potentially also calmer funding conditions for many of the large corporates, that's definitely a plus for these markets. And for that reason, we do expect the emerging markets to grind out continued positive performance in the remainder of the year. And that's also the reason why we still have a modest overweight for the broader emerging market equities in our portfolios.
Homin, always great to chat with you. Homin Lee, who's a senior macro strategist at Lombard Odier. One of the stocks we're watching here in the Sydney session is Qantas, which is trading at the moment. This is a picture as Qantas announced that it expects that a significant amount of customer data was stolen in a cyber attack targeting one of its contact centres. You're seeing a little bit of downside, about 0.6% there. The airline is investigating how criminals gained access to a third-party platform used by the call centre that held the service records of some 6 million customers, according to that statement. An initial review confirming that the stolen data included names, email addresses, phone numbers, birth dates and frequent flyer numbers. Financial information, credit card details and the such are not held in that system, according to Qantas. More ahead on the Asia trade, this is Bloomberg.
President Trump says he's not considering delaying his July 9 tariff deadline while renewing his threat to cut off talks and impose higher rates on several nations, including Japan.
You're writing letters to a lot of countries, and I think you're just starting to understand the process. We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough, and therefore you'll pay a 30%, 35%. Or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
Bloomberg editor John Herskovitz joins us now for more on this. And this is quite an interesting turn, right? Because when we started these trade negotiations, we thought Japan, being such a solid ally of the United States, would be one of the first to get a trade deal. What happens if they don't?
Yeah, I mean, Trump, as we saw in that clip right there, is threatening Japan with 35% tariffs. When he announced the initial tariffs in April, Japan was at 24%. So he's looking at even higher tariffs for Japan. And we also have the sectoral stuff that's going on. We have it on steel, we have it on Japanese autos. So I think the worry in Japan is that Japan will be used to make an example for other countries. If you don't make a deal, we're going to punish you like Japan. That's one of the worries here. And with this threat of even higher levels, it doesn't seem like the worries are going to decrease.
I mean, we always have to take everything that the Trump administration says with a grain of salt, but they seem to be very close to a deal, at least with India.
No, exactly. India had a bit of a head start. Modi went to the White House in February, one of the first foreign leaders to greet Trump. India and the U.S. had been in talks for a trade deal. At that time, they were looking to roll something out in the fall of this year. So they have a head start. There are still some differences on some issues, like India is objecting to U.S. proposals for genetically modified food. The sectoral things are a concern of India, especially with pharmaceuticals, a key portion of India's exports to the U.S. But India's Foreign Minister Jai Shankar said the deal looks good. They have trade negotiations going on, and the U.S. sees India as a crucial partner. So things with India are on a decent track. With Japan, there are a lot of headwinds, and the July 9th deadline just doesn't look like it's going to be met when it comes to Japan.
What are we seeing when it comes to the key talks between the US and China? Because this seems to be coming down to the flow of rare earth magnets from China to the US.
Yes, we had the Treasury Secretary Bessent saying that the flow is coming, but it's not going at levels before the Trump administration announced its huge tariffs in April. So they're not coming at the levels the U.S. wants, and this shows a little bit about China being able to use this key component as a choke point. These rare earths are key for tech sector, they're used for defense industry, and China is perhaps showing that if things don't go as planned, they could use these rare earth magnets as a way to put pressure on the U.S. So they're back, but not at levels that the U.S. wants and that they thought were agreed to when they reached that sort of deal with China a few weeks ago.
Bloomberg editor John Herskovitz there. And the latest Big Take Asia podcast digs into the impact of the trade war on U.S. importers and Chinese manufacturers and what it ultimately means for the American consumer. You can find that at Apple and Spotify. Well, some House Republicans are threatening to defy President Trump and sink the Senate version of his signature tax bill in a vote due on Wednesday in the House. The bill only squeaked past the Senate on a tie-breaking vote cast by Vice President J.D. Vance. For more, let's bring up Bloomberg senior editor Derek Wallbank, who joins us now from San Francisco. And Derek, our previous guest said, the unique thing about this bill is it seems like it doesn't matter if you're a moderate or an ultra-conservative GOP lawmaker. There's something for everyone to dislike in it.
Yeah, that's exactly right. What you're going through right now is what I would refer to as a lot of no's before you get to yes. Bear in mind, there was a lot of agitation in the House Republican Conference the first time that this went through, and now the bill has been in the eyes of many in the center, or toward the center of the Republicans, as well as toward the sort of hard right, has been made worse. It had a lot of necessary Senate changes to get through the Senate's particular process, took some things out that were key provisions that helped secure votes there. And so now the president has a job ahead of him to whip support for this. The goal is a vote tomorrow. I say goal because, when you have the votes, you vote. And when you don't have the votes, you don't necessarily vote. And right now, both parties are going through an epic whip operation to try and figure out where their votes are. And I mean that not just ideologically, but physically. Weather delays on the East Coast have snarled flights, and that means that many lawmakers who are trying to get back to Washington are struggling to get back to Washington. So that sort of complicates the math a little bit more here as well.
And Derek, we know that Elon Musk was never necessarily happy with this tax cut bill, but now we have President Trump threatening his immigration status. I mean, we were all amused at this ongoing reality TV show, but this sort of threat is really hitting at the core of American democracy, isn't it?
Well, the feud between Trump and Elon Musk, got really personal really quickly, and then it sort of died down and pared back a little bit, and now it seems to be reigniting again. There's two things that are being done here. One is, as you said, Trump sort of openly musing about on the immigration, but the other one I think bears a lot of witness or a lot of attention, which is to say the federal contracts to Musk's companies. Now, Musk and his firms are quite large in the way of federal contracting, and quite diverse too. There is a broad range of things from Starlink internet all the way to sending U.S. astronauts up to space and getting them back down safely. And in some cases, it's really, really difficult to untangle Musk and his sort of empire from the federal bureaucracy. This was the case even when Joe Biden was president, but it got a lot more entwined when Musk became the face of Donald Trump's effort to slash the size of government. Even so far as John was talking about trade deals, there were some countries who were provisionally approving Starlink access because they weren't sure what else to give the United States and the Trump administration. So they figured that doing something nice for Musk might be some way in there, right? So that's how tight they have been. Unwinding that is very, very difficult, but it does come with a certain amount of risk for Musk, his companies, and his investors.
We're Derek Wallbank there with the latest on Washington. We have more ahead on the Asia trade. This is Bloomberg.
are determined to continue to be data dependent, to decide meeting by meeting, and to not commit to any particular rate path.
We are going meeting by meeting. I mentioned how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve. But as I mentioned, a majority of us do feel that it will be appropriate in the remaining 4 meetings of the year to begin to reduce rates again.
It will depend on the relative strength of the 3 inflation dynamics, and we need some more information to determine that.
We are going to have to see those come through, though. I mean, come through into prices. I think we've still got to see the evidence and prices. But that background context allows certainly me to say, look, I think the direction of interest rates continues to be downwards.
We cut our interest rate 100 BP from last October, and we will continue to be in an easing cycle given our growth rate. But recently, financial stability risk has been rising. So we are keeping an eye on this financial stability risk in deciding the pace and the timing of the further cuts.
Some of the world's top central bankers are speaking to Bloomberg in Portugal at the ECB Forum on Central Banking. Take a look at how we're setting up when it comes to futures starting to trade in Europe this morning. It was a mostly down day, although we did have some upside when it comes to the luxury names, including the likes of LVMH. We had some optimism from Goldman Sachs suggesting that we could see a bit more of a recovery in that part of the cycle. We are seeing a little bit more upside there. Euro Stoxx 50 futures there trading a little bit higher. We're also seeing German DAX futures mostly in the green as we continue, of course, Shery, to monitor some of these trade and tariff headlines.
And Haidi, another story that we're following in Europe. French President Emmanuel Macron and Russian leader Vladimir Putin have agreed to coordinate their approach on Iran in their first phone call since 2022. It's part of efforts to forge a common approach on Iran between the 5 permanent members of the UN Security Council. During the call, Macron also pushed for a Ukraine ceasefire, but Putin rejected it, insisting any deal must address the conflict's root causes. President Trump saying that Israel has agreed to conditions for a 60-day ceasefire in Gaza. In a post on Truth Social, he says mediators will now deliver the proposal to Hamas, warning them the deal will not get better, only worse. Trump had earlier said an agreement on Gaza could come as soon as next week. Israeli Prime Minister Benjamin Netanyahu is set to visit the White House on Monday. Iran is said to be cutting off communications with key UN nuclear officials. Sources tell us Iranian regulators have stopped taking calls from the IAEA after formally ending inspections last week. This complicates U.S. and Israeli efforts to prevent Iran from developing a nuclear weapon, with Tehran potentially using strategic ambiguity to dictate events, echoing tactics used during the Cold War. We have oil continuing to gain in today's session. We'll have more ahead. This is Bloomberg. Fed Chair Jerome Powell saying that the central bank would probably have cut rates further this year if not for President Trump's expanded use of tariffs. You can see right there the treasuries are holding steady. Markets really pricing in about 2 rate cuts for the Federal Reserve this year as early as this month. Chair Powell speaking about the state of the U.S. economy during a monetary policy panel in Sintra, Portugal. Take a listen.
The U.S. economy is in a pretty good position. Inflation has come down close to 2%. We're at 2.3 headline, 2.7 core. The unemployment rate is at 4.2%. So we're healthy overall. If you ignore the tariffs for a second, inflation is behaving pretty much exactly as we have expected and hoped that it would. We haven't seen effects much yet from tariffs, and we didn't expect to by now. We've always said that the timing, amount, and persistence of the inflation would be highly uncertain, and it's certainly improved that. So we're watching. We expect to see over the summer some higher readings, but we're prepared to learn that it can be higher or lower or later or sooner than we'd expected.
But, Chair, would the Fed have cut more by now if it weren't for the tariffs?
So I think that's right. In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up, and so for now we're waiting.
Fed Chair Powell there at the ECB forum in Portugal. Take a look at what we're watching when it comes to some of these dollar trading pairs. Of course, we're coming off the worst 6 months for the US dollar since 1973. The Hong Kong dollar has been one that we're watching in terms of the stepping up the defence of the FX peg. That fixed range has been tested again. The de facto central bank ramping up purchases of the Hong Kong dollar, seeking to defend that peg that's really been continuously strained by volatility in the greenback. We're also watching dollar yen at the moment as we continue to hear that sort of cautious as she goes tone from Governor Ueda in terms of normalisation of monetary policy, but it does look like further pressure is really going to come on when it comes to dollar yen going forward. Let's bring Garfield Reynolds, who leads the Markets Live Asia coverage for us out of Sydney. So, Garf, what are we sort of seeing or bracing for here when it comes to trading in dollar yen?
Well, two issues going on here. As ever, a lot of it has to do with monetary policy. We heard from Chairman Powell in Sintra. He's sounding as unsure as ever about what comes next, which means he's definitely going to be on hold. That's not necessarily helping the dollar much, though, because there's so much volatility centering on the dollar and so much uncertainty at a time when the position for other currencies is becoming a little bit more certain. The yen has probably helped somewhat by the way that yesterday's JGB auction went off calmly. If we get another calm auction later on this week for 30 years, that would really help to soothe Tokyo traders' nerves and remove some of the reasons for the BOJ to take it even more slowly than they would otherwise do when it comes to normalizing policy. So all of that is leaning towards yen gains against the dollar, especially at a time when we've had that very, very strong surge in the euro. There's a lot of expectation that would continue, but you would expect to see perhaps some rally fatigue when it comes to the euro. That puts the yen in the spotlight as having the potential to take over in an environment where the bearish dollar tone is still very strong.
When it comes to the ongoing, I guess, some renewed hawkishness on trade that we're hearing from Trump, right? Are markets kind of largely ignoring this?
Yeah, for the moment, markets are very much looking through it because the TACO principle.
Even with the extra harsh kind of words on Japan.
Yeah, well, it's a little bit like if you look at what President Trump has been saying in response to some of Elon Musk's comments, that also sounds pretty alarming. And yet, I don't think Tesla stock has really fallen out of bed. It might not be doing brilliantly, but the general attitude from traders is that they will trade actions rather than rhetoric at this stage of the day. And the actions since Trump put in the delay in early April to unwind the severe damage done by the introduction of reciprocal tariffs, those, the trading book is whatever Trump says, he is likely to avoid major damage. There will be further delays. Any hint that he's done enough to seriously damage markets will cause him to pull back. So that's reassuring investors that even as he fulminates against Japan's unwillingness to buy US rice or US cars, he's not likely to impose truly brutal sanctions on such a major trading partner, precisely because of the damage that could do to US markets as well as to Japanese markets.
The dollar strength story is really having a lot of implications. Perhaps, we're watching the Hong Kong dollar very closely, right? Is the viability of that peg really in question now?
It doesn't seem to be. It's more that I think the Hong Kong dollar is finding itself in a bit of a unique situation in that because of a range of factors, including dividend payments, including China's overall policy mix, borrowing costs in Hong Kong are very low, and the currency is restrained. So because of that, you get carry traders and arbitrageurs betting, going short the Hong Kong dollar either in order to just make money on the movements or simply to earn the carry they can pick up. Now, elsewhere, you wouldn't be particularly willing to take on carry trades of that type because what's going on with the US dollar would hurt you. But the US dollar is stuck, so you're kind of getting paid to play, as it were, by the dynamics of the Hong Kong dollar peg.
Bloomberg's Garfield Reynolds there joining us with the latest on the broader markets as we're now following one stock here in Japan, Softbank, under pressure right now, and Bloomberg learning that its acquisition of semiconductor designer Ampere is facing a potentially lengthy probe by the U.S. government. The Federal Trade Commission has opened an in-depth investigation of the takeover. This, according to people familiar with the matter, who are talking about this second request for information about the transaction. Only a small portion of deals face such follow-up requests, and in some instances, investigations can last for a year or more, and also could be the lead-up to lawsuit to actually block the deal itself. We haven't gotten any comments from Ampere or Softbank, the two companies, of course, that are trying to merge, but a representative of the FTC also declining to comment. This would have been an all-cash transaction by Softbank, valuing Ampere at $6.5 billion, which was announced back in March and could now face a lengthier probe by the U.S. government. But let's turn back to Sintra and the ECB forum, because, of course, we want to delve into those comments by the Bank of Japan Governor Kazuo Ueda, who's now saying that he's in no rush to raise borrowing costs, signaling a wait-and-see approach on monetary policy. He was speaking at that annual forum in Portugal. He also noted that the BOJ is closely watching how U.S. tariffs could impact inflation.
Headline inflation has been above 2% for almost 3 years, while what we call underlying inflation is still somewhat below 2%. That's the situation we are in. But if I could decompose it further, there's probably about three components to it. First, there's underlying inflation dictated by wage price dynamics, whereby increases in prices affect wages, which further affect prices, helped by resilient domestic demand. This component has been going up slowly, but as I said, it's still somewhat below 2%. Then there's going to be perhaps a second component, which will be the expected negative effects of possible tariffs on the economy and on prices. We are expecting this to take place, but we haven't seen that yet. There's a third component, which is a domestic supply shock generated by increases in food prices. Actually, this component accounts for about 50% of the headline inflation we've got at the moment. So netting these three, we think the first component and the second component will produce a slow increase in underlying inflation toward 2% by end 26 or 27. The third component, food inflation, is going to subside toward the year end. So that we will be closely monitoring interplays between these three forces.
But, Governor, how do you view trade concerns the day after President Trump threatened Japan with more tariffs?
Well, it's being negotiated by our minister in charge, so I'm trying to avoid making any specific comments on this.
So let me just ask you, what will be the key trigger for Japan for deciding further rate hikes?
Okay, as I said, it will depend on the relative strength of the three inflation dynamics I was describing, and we need some more information to determine that.
Bank of Japan Governor Kazuo Ueda, they're speaking with Francine Lacqua at the ECB Annual Forum in Portugal. We do have more ahead on the Asia trade. This is Bloomberg.
Chinese auto stocks could rise today after many reported upbeat sales growth in June compared to a year ago. Citigroup estimates the new energy vehicle sector's wholesale shipments seeing a 34% jump on year. Let's bring in our China correspondent Mingmin Lo in Hong Kong. Mingmin, so upbeat sales forecast for Chinese car makers this year, sort of defying the broader narrative that we've seen about a weak consumer outlook.
Yes, definitely. Our Bloomberg intelligence team as well projecting a 30% growth on year for the new energy vehicle segment. And a part of it is because of those government subsidies subsidizing the upgrading of the car trade-in segment of the market. Plus, you got that intense competition, price cuts, abundant new models. All of that played a part. There's a renewed vigor into overseas exports as well. You look at BYD, they're 10% growth on year, but that's partly because of aggressive price cuts, discount as much as 34%. You compare that with some of its rivals like Geely, 59% sales growth on year in June. Look at XPeng, 224% growth. NIO, 17%. Really huge numbers there. Granted, some of these other competitors are working off very low base compared to BYD, some of them at 5-digit numbers when it comes to their sales level. But BYD has seen about 2.1 million sales of cars units in the first half of the year, but that's still actually less than halfway to their full-year target of 5.5 million. So BYD's growth actually has been slowing in contrast to some of its competitors. Perhaps that price competition really hitting a little bit too close to home, and you can see on that chart there actually companies like Leapmotor are actually being rewarded by investors, whereas BYD losing about $20 billion in market cap over the last couple of months since the May peak, because of concern over those profit margins, regulatory scrutiny, because regulators had started paying notice to this rat race, calling on the industry to self-regulate when it comes to prices. They're also scrutinizing how some of these companies are perhaps leveraging on supply chain financing as a form of debt. So that caused BYD and other companies to commit to this industry-wide agreement to start paying suppliers within 60 days in order to avoid scrutiny, because many of these companies, especially if they have dominance over the industry supply chain, they're able to squeeze the upstream suppliers a lot more for more profit margins.
We are seeing some progress made when it comes to obtaining market share for some of these brands in Europe, right, despite the EU tariffs on Chinese automakers.
Yes, it's interesting. We are now actually back to mid-2024 levels before those tariffs have been imposed. And if you look at Chinese brand registrations in the EU, if you include the ICE internal combustion engine vehicles, we have surpassed 5% for the first time. BYD once again taking the lead along with SAIC, both of them reaching 9% market share when it comes to the hybrids and the electric vehicles. And here on the chart comparison here, you can see between battery electric vehicles and the hybrids, we are seeing a much more dramatic rise in the market share of hybrids because those tariffs actually don't apply to hybrid vehicles. So we have seen how the tariffs had made an impact and distorted the market somewhat, because companies like SAIC, for example, are starting to pull back on this full battery electric vehicles, focusing more on the hybrids. BYD as well, they are forced to introduce the lowest, the most affordable vehicles, targeting the entry segment because of the tariff levels as well. But still, the intense competition at home really driving these companies to search for market overseas, and the EU is one of the most important markets for them.
Bloomberg's China correspondent Mingmin Lo there. Take a look at some of the Tesla suppliers trading here in Asia today. This, as we've seen a number of news headlines, including the weak sales returning to the fore for Tesla after the debut of the robo-taxi. The quarterly sales numbers are expected to be quite muted. In addition, we're also seeing the resumption of that feud between Elon Musk and President Trump, with President Trump being asked about the possibility of deporting Elon Musk, saying that he would take a look at it. We are seeing definitively down trading when it comes to some of these suppliers here in Asia. For more, let's bring our global business editor Karen Lee. So what are the drivers when it comes to this expectation of downbeat?
Right. I mean, well, muted is definitely the word around Tesla right now. And to understand why, let's look at a couple of those numbers coming across the terminal and what's been happening with the company and Elon Musk around them. Just looking now, analysts estimating just under 400,000 vehicle deliveries. That's a 12% drop from last year. Second consecutive annual decline in sales. That's down 8%. The stock has had a rough start to the third quarter. And as you said, Elon Musk and Donald Trump have renewed their feud this week over a $3.3 trillion tax and spending bill. The latest is Musk calling the bill insane. Trump saying he would look into having Musk deported, look at having subsidies removed from his companies, which is obviously a huge thing for investors. And a couple other things to watch, Heidi, whether Musk continues to alienate customers in some key markets and whether Tesla continues to be a point of ire for people protesting the U.S. government. And whether cheaper new cars are going to materialize. Now, when Tesla reported earnings in April, it said new affordable vehicles were on track to production in the first half. They haven't materialized yet, so that's something analysts are watching very closely, and so are investors.
Yeah, the alienation of some of the car buyers is really important, right? When you buy a Tesla, what sort of political message are you kind of sending out there, given Elon Musk's role with the Trump administration and, of course, the ongoing feud? What's his business strategy now?
Yeah, well, this is interesting. So the latest is that he's going to assume oversight of sales in Europe and the U.S. That's what our autos team is reporting after the departure of a longtime deputy there. So it'll be interesting to see what he does. He's obviously a big showman, a big salesman, and he has managed in recent months to divert some investor attention away from sales by using the robo-taxi, by promoting the service that started up late last month. It's only offered rides to a handful of people in Austin so far, but even that excitement was enough to boost shares. So we're going to see what else Elon has up his sleeve and how people are going to react to Tesla as a brand, not just in terms of what they want to drive, but in terms of what their politics are.
Global business editor Karen Lee there with the latest on Tesla. We have more on the corporate front. Wall Street's largest lenders have boosted their dividends after passing this year's Fed stress tests. The annual review showed that all examined banks would maintain enough capital to withstand a hypothetical economic downturn. The Fed made the stress tests easier to pass by softening some requirements and plans to make further changes to reduce volatility. Season 3 of Squid Game has shattered records, drawing over 60 million views in just 3 days. The final season of the violent dystopian thriller also hit #1 on Netflix in 93 countries. The show's global success underscoring the rising appeal of Korean storytelling. Netflix says 80% of its members have watched Korean content since Squid Game debuted in 2021. We have more ahead. This is Bloomberg. Thailand's Constitutional Court has suspended Prime Minister Paetongtarn Shinawatra while it reviews a petition seeking her permanent removal over alleged ethical misconduct. For more, let's bring in Bangkok Bureau reporter Papicha Tanaka Sempipat. Papicha, so what happens now?
Shery, now the Prime Minister will have to fight for her survival. She's been given 15 days to submit her defense to the court while it deliberates on the case, which could take weeks or months. But in the meantime, the government will still be able to function under an acting leader, and the newly reshuffled cabinet will be able to begin its duties when it's sworn in as soon as Thursday. While that should ensure a degree of policy continuity, we should expect some slow decision-making from the part of the government, as it will be quite distracted by the ticking time bomb that is the Constitutional Court verdict. And there is legitimate cause to be concerned, as this is not the first time that the court will get to decide the fate of Thai prime ministers. Paetongtarn's predecessor was also removed from power last year by the same court over a similar ethics violation case.
We've also seen this adding to the woes when it comes to Thai's financial markets, right? The market is the world's worst performer this year. All of the gains over the last 12 years or so have been reversed. So what are we seeing here?
The Fed actually rallied 1.9% yesterday as investors heaved a sigh of relief over what they think would be the de-escalation of protests while the court deliberates on the case against the prime minister. It remains to be seen if that is just a relief rally, though. As you said, the Fed is the world's worst performer. It has slumped more than 20% so far this year, it remains to be seen if that would extend. And the baht will also be weighed on by the crisis, likely even after it has been supported by the decline in the dollar as well as a retreat in oil prices and also political uncertainty. Any prolonged period of that will likely trigger more sell-offs in the Thai stocks as foreign investors have sold more than $2 billion worth of that this year.
So a great deal of uncertainty there. Our Bangkok Bureau reporter Patpicha Tanaka Sampipat there with the latest on that. Let's take a look at how futures are shaping up as we head into the start of trading across Greater China in the next half an hour or so. Some downside when it comes to Thai's futures. Watching the Hong Kong dollar as we saw that move in to defend the dollar peg again from the HKMA. At the moment, we're seeing S&P futures looking pretty flat at the moment. Japan leading cash markets lower at the moment.